What's up, guys? I'm Jamie Tajera with Property Bear, and this is the Nerd Report for September 2022. We're going to review everything about August, all of the numbers, and talk about how it affects you. I'm Jamie Tajera, co-owner of Property Bear here in Jacksonville, Florida. This is Carrie Hustis, co-owner and sales leader. While Carrie runs all things sales, my day-to-day hunting investments and developments keeps me in two main places. In the field, checking out potential opportunities in construction, or on the computer, researching hyperlocal data. So if you're looking for insight on Jacksonville real estate, you've come to the right place. Thanks for checking out our channel, and if you like it, please be sure to subscribe. So the first thing we always start off with is, what are we buying, upcoming deals, what we're looking for. We've actually spread out our search radius from just Duval, Clay, and St. Johns County to now include Flagler and Volusia County. And we can go a little bit as far as North Orlando on the single family side. On the land side, for anything 8 acres or more, we are looking for St. Johns and Duval County. That's kind of where we're sticking. And then as far as the bigger multifamily projects, Florida, Georgia, we are interested in other markets. We'd really like to be able to drive there in a day and get back. So that's kind of what we're looking for. If that's, we're still buying single family homes no matter what. It's interesting that, I'm watching the S&P 500 this week, after Jackson Hole kind of take a hit, and real estate's kind of the same way. I mean, it's just you make or lose money where you buy it and then how you improve it. But I have learned, I'm 35 at this point. I'm obviously on the investment side of Property Bear, but I have experienced a feeling of I should have bought more twice in my life already. And that's not really something that I enjoyed, right? One was in 2009, 10, definitely should have bought more houses. And then the second time was before COVID. And I'm thinking in my mind, what's the best way to avoid that? Just keep up with the market and make sure that we have all the funding we need to be able to attack those opportunities whenever they come up. Because I remember when COVID hit, we actually sold some of our flips thinking, as fast as we could, thinking everything was, going to go down. We wanted to hold cash, which was a terrible idea. And then 6 months later, almost everyone we sold a flip to ended up selling it for $100,000 more. So you don't know what's going to happen. So even though we're looking at certain numbers thinking we know what's going to happen, the economy tends to have a rug pull effect where it just surprises you and what's going to happen. So let's jump into the numbers for August. So for the past month. So our sales price dropped from 377 to 365. It's a 3% drop. And then year over year, we're still up 18%, which is pretty much in line with the Case-Shiller index for June, right? So if you're looking at Case-Shiller, it's 2 or 3 months behind. June, July, August. Yeah, so it's 3 months behind. So, and I personally expect that number to keep coming down. I mean, the whole thing with what the Fed's trying to do right now is reduce inflation. Housing's a big part of that. So they want that number to come down. What they're not paying attention to, though, is that the actual cost of home ownership is going up due to interest rates and not necessarily due to pricing. So someone ends up reaping the benefit, of that, of those loans and the interest on those. So sales price, keep in mind all the numbers we're running are inventory across the board, new construction, townhomes, condos, single family, everything, St. Johns, Clay, and Duval County. So if we change up the filters on that, the numbers are going to change. But for our general 3-county area, we're at 365. What's my next one? So months of inventory. So for months of inventory, we're still at 2.6, and it looks like it curbed a little bit. we talked about this last month, but I think I know why this is curbing, right? Generally during school, the market will slow down. The last 2 years, seasonality hasn't really affected us. It's just been crazy the whole time. Also, keep in mind, we're looking at like, let's go 4 to 6 months is average, is a balanced market. We're still mathematically in a seller's market. Now, here's the other side of this. Last month, I said that the hard part for these price points and for buyers is that for buyers the interest rate keeps going up, but the sellers don't need to sell. Because I'll give you an example. If you have somebody that, and we're going to go over the distress numbers that's going to kind of back this up. If you have somebody in a $300,000 home at a 3% interest rate, right? Their payment is around $1,500-$1,600 a month. Well, that house is, if that's their mortgage and they bought it, let's say 2 years ago, right? 24 months ago, they don't need, if they sell, they actually end up in a worse position, right? They're going to either end up spending more money on rent, or they're going to go turn around and try to buy. If that $1,500 or $1,600 a month payment is straining them, they actually can't sell, and move into the same financial position. If they sell, what ends up happening is they could potentially collect a lot of cash, but all they're doing is robbing Peter to pay Paul over time, right? They're just using that cash equity to now pay these higher payments, right? And then they run out of money. But a seller doesn't necessarily need to sell. And it's actually not in their best interest to do so. And I know that sounds crazy, but I think sellers are starting to realize that, which is why you see this little bump over here where it's not just shooting straight up. Now, sellers are saying, wait a second, if I sell, not only where am I going to go, even though there's more inventory, right? Which is great. But if I go, it's going to cost me more. Like I'm not moving from like a B class property, right? Whether it's condition, area, whatever, right? To an A class, right? I'm basically going from B to C, and it's costing me the same amount of money, or I'm going from B to B and it's costing me more money, right? So as a seller, that's what I would look at. As a buyer, you could potentially, be looking at offering, if a seller wanted to, but some sort of like creative financing with subject to, where you can still retain that 3% mortgage, right? If this seller actually wants to sell, and then giving them, whatever that balance is in cash. Obviously that requires a different scenario, but that would be what we're looking for in like the multifamily space or some of the bigger stuff, because we'd rather not get that 5% interest rate if we can get a 3, right? On the commercial side, or 6, or whatever the number is. So month supply of inventory, cool. Active inventory. So it's weird because this is showing, oh, sorry, there's another chart that kind of looks like that. But you can see it shot up to 5617, right? Last, in July, and then it dropped again. Why is that? I think it's because of what we're literally in the same spot we were almost a year ago with sellers, because they're realizing, it's just a different situation, right? Because a year ago, interest rates were still low. They could still get a good deal. It could still be a lateral move, but you've got a seller basically saying, I would sell, I have nowhere to go. Well, now that same seller has this thought in their mind. I can't sell because it costs me more to move, and not physically move my stuff. It literally costs me higher interest rate, higher home prices. It's like, why would I leave? And we're seeing that on the investment side, unless it's a second property, an inherited property, it's really hard for an owner occupant for it to make sense for them to move the property. And being in Jacksonville, Florida, one of the things that affects those second properties, why, you're seeing the luxury market take kind of a hit if it's for second homes and stuff like that. We can basically take these numbers and adjust them for just the luxury market, and their numbers look worse. And we can probably do a separate video on that. but their numbers look worse. Why do they look worse? Because our insurance rates in Florida are terrible and interest rates are higher, right? And the prices are higher. On a second home, you don't get the advantage of homestead or anything like that. So like here's the thing, even if I would have bought a, $2 million home 2 years ago, the most my values can go up are 3%, in Duval County. I'm pretty sure it's like that for Florida as a whole, but it can only go up 3%. If that property is a second home, my property taxes just went up by what, 18% in a year, right? That's a lot. So that's where, those second properties, is where it creates a financial strain on the owners, but not so much their primary homes, which is why I think the active inventory, you're seeing a drop. And the more sellers get educated, and I know that we have a a retail team with agents, with Carrie, and they do all that. And I'm not trying to shoot anyone in the foot, but I think sellers are starting to realize like it's not a smart idea to sell unless I have to. So like if I have another property and it's costing me a lot of money with insurance and taxes, sure, have the conversation, consider selling it. Or if you're in a situation where you have to absolutely move, do it. Otherwise, I would say think twice about it, and I think people are. So what's our next one? Active inventory, closed sales. This is going to look like a barcode. I'm probably going to take this out because no matter what, this is something that I have kind of, realized, and I've heard it before, but I always thought it was like a motivating thing. The same number of houses close regardless of the, regardless of the market, right? So was there a time where there were a lot less closed sales? Yes. But when you're looking at it, within a reasonable time frame, right? It's just a barcode. It just goes up and down, up and down, up and down, and it's pretty much the same. And you can see a trend line where yes, it's going up, right? So kind of makes me think of like stocks with like higher lows, right? And then you have a transition back down. The thing is that this from a investment standpoint or a sales standpoint, the same number of houses are going to close no matter what. Yes, it'll go up, it'll go down. But there's so many factors that we can't control. Like I'm even looking at the new construction side, and there's a backlog of inventory which is not going to flood the market because we're still having delays with labor, materials, like all of this stuff, and it's not all going to pour onto the market because there's another invisible hand that we're going to talk about in a little bit. That may not allow these properties to go to market. So let's check out the next one. All right, days on market. This is important if you are a seller. And again, we should probably do this and break it into different price points. But if you're a retail seller, like you want Carrie or somebody on our team to list your house and get the videos and all the drones and all that stuff, it's good to know, they're going to break these numbers down for you, and you're going to know, is my house going to sell in like 5 days, 10 days, 20 days. On the investment side with the flips, I have to separate myself as a regular seller because I do the same thing that you guys do as regular sellers. Well, my house is worth more, blah, 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 blah. And I'm like, I need to separate, right? That's why I don't list my own houses. So, turn it over to the team, and I'm like, blindly, I don't want to give you my input on what I think it needs to list at. What do you think it needs to list at? The strategy is to honeypot list it. And if my comps are showing me, we've got one that has comps all day, appraisal comps at 500, at 500. We're actually going to list it at 450 with the intent of getting multiple offers and boosting over that 500, right? And the strategy behind that is, one, create a feeding frenzy. Two, don't chase the market, right? You're going to get the highest offer you're going to get on the open market with them marketing it. I can't say that for every agent, but I get to sit in the background and say, yeah, you guys are doing what you're supposed to be doing. The staging, the photos, like all that stuff, right? I don't want our flips being on the market for 30 days. I just don't. I want them to be off the market in 10 days, 15 days. I want to beat the average 100% of the time. That's what I want from, from our retail team. And they do that. They do it with pricing. They do it with marketing. So if you're a seller and you're hitting the average, you want to beat the average. And you beat the average by picking the right retail team to do that. And keep in mind, this is an average. So people are selling for faster than the average. I know that because our houses are selling faster than the average. And there's people selling higher than the average, right? Sorry, the median. I always say average. I'm not going to go back and fix it all. But that's the thing, right? So there's still people that are trying to chase the market from 6 months ago that are overlisting these properties, and sometimes they get lucky, and their houses will sit for 40 days, 45 days, and they might still get it, and they might still get an appraisal. If that's the gamble you're playing, play it. I like the feeding frenzy model better, because if an appraiser questions the value of a property, I hear this conversation in the office all the time with appraisers. It's, we believe that the purpose of the appraisal is to justify and identify, right, what the market is willing to bear. In this case, we had 10 people make multiple offers on this property, which pushed the price up to this number, which is telling us that's what the market will bear, right? It's much easier to justify that than have to work the other way, overlist it, and then justify to the appraisal or to the appraiser, yeah, we only got one offer, but I really think it's worth it. It's got nice windows and nice tops. Like, that is a losing conversation. Like, you already know that person's in the loser seat. So that stays on market. You're at 30 days. If you're a buyer, it means you don't have to stress out as much, right? So that's good. Mortgage rates, 300. 3%, 720, 739, you're at 6.4%. Cool. If you're in a position where you have cash, I would consider, and you're buying, I would consider talking about subject to and potentially putting a lot, more cash down if you can, and retaining those, that low interest rate. If you're going to live in the house for more than, I would say 7, 8, 9, 10 years, try to get a lower interest rate, whether you're buying it down or whether you're buying down the points or whether you are trying to do some sort of subject to thing. Because the thing is that nobody ever does the math, but I can overpay for a house by like $20,000. And if I get the right terms, in the span of 10 years, I'm going to pay less than the guy who got the better deal. You know what I'm saying? Like, just do the math. And builders right now, the incentives are coming back. I know that with Breeze Homes, we're offering a certain amount on, we have no inventory homes. So we just released the townhomes at Ellis Road, and we've already sold one. We've already got 3 or 4 people lined up. So we are offering incentives to make the properties more affordable, because with Breeze Homes, that's like the number one thing. And we want the funds to go towards point buy down, not so much closing costs. And it's up to the customer what they want to do. But if you're going to live in the house for more than 10 years, the cost of the cash for those closing costs does not equate what you're going to pay over those 10 years in interest if you take a higher interest rate. Keep in mind, and I've never had an interest rate over like 5%, right? On a fixed, right? On the investments, some of you guys know we're at like, 8, 9, 10% on those. But on, long-term rate and term, never over that number. And I know my parents always tell me, yeah, the first house we bought was at like 7.5%, right? And we've got people talking about interest rates being at like 12%, which is that would kill the market. But people were still buying and selling houses back then. So and here's the crazy part about it. People always say, I wish I could have gone back in time to buy houses in a certain neighborhood, right? So like, look at Riverside, 25 years ago. you can see some sales in there for like 50 grand. Springfield, you can buy houses for like 20 back then, right? But, that's crazy. 20 years ago is what, only 2,000? Go back to the 80s. Wouldn't you love to have home prices back to where they were in the 80s? Like, wouldn't you buy everything that you can possibly buy? Sure, but now you're paying, double-digit interest rates. So in that 30-year span, you can kind of time your window. It's easier to time your window based on interest rates than it is to time your window on purchase price, right? So the other thing that I'm going to add in here is that we're going to look at, I want percentage of list price received. So this looks like a pretty steep drop. Keep in mind, this is over 100%. If you follow anything real estate related, over the past 2 years, you're seeing people say, I got multiple offers, highest and best, all this crazy stuff, right? Those posts kind of went away because everybody was getting it, so it wasn't cool to actually be good at your job as an agent anymore. But that world's going to come back. Now, your median, right? Oh no, so this is actually average, right? So your average is still at 98.6%. If you can beat that 98.6%, you're doing good. Here's the thing though, because of the way the market's been in the last 12 months, people are still over listing stuff. They're listing it too high. It happens literally all the time. It happens in residential, commercial, like it just happens. And especially today where there's 4 million real estate agents, like not even half, but like most of them don't know what they're doing. So they're going to overlist, right? And the customer, like we see this happen all the time where the customer just goes with the agent that tells them the highest price, and then their house ends up sitting on the market for 80 days. Like we haven't seen this in the last 2 years, but before that we saw it, and it's coming back now. And those guys are going to get out of the business, and it is what it is. But those sellers will suffer because they're not paying attention, right? But that's why you're seeing these numbers come down. I'm not thinking that this is like home prices crashing or anything. The only thing that would tell you that is the sales price, which you did see it went down like 3%. But year over year, you're still up 18%, which you're crushing it, right? All right, and then here's the other thing. The people who keep saying that the market's going to crash. This is what we like to look at, but I didn't know that it was available on this platform. Usually, I'm looking at the foreclosure auctions, and the foreclosure auctions have zero inventory on them. It's not. The auction started at 11. It's almost like not even worth looking at because there's not enough inventory there, for us to buy. So we'll scan it, but it's not even fun anymore. So so this is all the listings that hit the market that are distressed. So like your REO, foreclosure agent, stuff like that. When this starts ticking up to, even at 5%, like nobody thought in 2018 that the market was going to crash, Let's look at it by year. See if this will give me 2008. Oh, of course not. Huh. Well, from 2018, we were at what, 3.4% of distressed listings, and now we're at like less than 1%. Distress, foreclosure, even the forbearance stuff, right? There's not enough of it for me to say, oh, there's a whole bunch of inventory coming to the market that's going to flood it and then supply demand and then crash the prices. I think the prices are coming down because of interest rates, affordability. They have to come down for people to be able to afford to live in them. Right, like let's talk about like the Jacksonville general market, right? If you can't afford to move to the general market, which is Jacksonville, right, you have to look at it relatively. What does $1 million in New York buy me? It buys me a, 400 square foot condo, right, in Manhattan, right? I don't want that. Like, I can't live there with my wife and son and my two dogs. Like, it's not going to happen, right? I don't live there, right? So what that gets me here is much more space, much more, et cetera. So relatively, if affordability becomes a problem for Jacksonville, right, there's going to be, secondary, tertiary markets created where it's more affordable to live, and that's just the way it works. So on the investment side, if you're a Keller Williams agent, we started KWREI. Check it out. KWAPinvest.com. You have to be a Atlantic Partners agent or investor to be part of the group. If you're a customer and you're looking to sell, buy, whatever, we get tons of phone calls with people that don't even like actually directly work with us, and they just have questions. They want to talk to our agents about what that whole world looks like. Give us a call. Call Carrie, call Sarah, call somebody on our team, and they'll go over these numbers for what you're looking to do in your area and your market and all that stuff. But thanks for checking it out, and we'll see you on the next one.